have thought that once you bought your home and took out a 30-year mortgage, that you would never have to apply for a mortgage again. After a few years, however, you may decide that it makes sense to refinance your home loan. Here's what you need to know to make a well-informed decision. Hi, my name is Billy Bryson with Bryson Team Real Estate and Home Loans. And if you're new to my channel, please make sure to subscribe, like this video, and leave a comment below. Also, if you or anyone you know is considering making a move or refinancing, please give me a call. You can pass on my number or visit my website for free, helpful real estate and loan information. So, what is mortgage refinancing? Refinancing a mortgage, it means that you get a new home loan to replace your existing loan. If you can refinance into a loan that has a lower interest rate than what you're paying, you'll save money. And the best time to consider doing a refinance is when interest rates fall sharply and sink well below the level that they were at when you closed on your original loan. Another good opportunity to refinance is when your credit improves to the point where a new loan has a lower interest rate just based off your credit score. As a rule of thumb, it's worth considering refinancing if you can lower your interest rate by at least 0.5 percentage. And if you're planning on staying in the home for at least a few years. Now, why should you consider refinancing? There's a variety of reasons that it might make financial sense for you to refinance your home loan. Number one is to reduce your monthly mortgage payment by securing a lower interest rate. Number two is you can get a shorter term, such as a 15-year loan, and replace the 30-year loan you currently have. This means you can pay it off a lot faster and save a lot of interest over the years. You can also switch from maybe an adjustable rate mortgage to a fixed rate loan. It may be a smart move if you think rates are going to go up in the future. To extract cash from your home's equity is another good reason. And this is known as a cash out refinance. Another good reason is to eliminate PMI, mortgage insurance. If you've built up 20% equity in your home, then that might be a good idea. So let's talk about how to refinance your mortgage. The process of refinancing a mortgage is just like getting a mortgage when you first bought your home. There's 6 steps that I'm going to share with you that could help you. Number one is set a clear financial goal. There should be a good reason why you're refinancing. Like I mentioned earlier, reduce monthly payments, shorten the term of your loan, pull out home equity for maybe cash to pay off debt or home repairs. Every situation is unique, so and everyone has different priorities. Number two is check your credit score and history. You'll need to qualify for a refinance just as you needed to get approval for your original home loan. The higher your credit score, the better refinancing rates lenders will offer you, and the better your chances are of an underwriter approving your loan. And something to consider is it may make sense. It makes sense to spend a few months boosting your credit scores before you start the process. Number three is determine how much home equity you have in advance. Your home equity is the value of your home in excess of what you owe on to your bank. To figure it out, just look at your mortgage statement, look at the principal balance that you owe your current lender. Then you can call me and I'll give you a value, or you can check online some of the home search sites and you can do your own value check. Just to get an idea of what your home equity might be. And it's the difference between the two. Obviously, it's what you still owe on the property. Let's say, for example, $250, and let's say the value is $300. Well, there's $100,000 equity. So something else to consider is that you may be able to refinance a conventional loan with as little as 5% equity, and you'll get better rates and fewer fees if you have more than 20% equity. But the more equity you have in your home, the less risky it is to the lender or to the bank. Number four is shop multiple lenders. Getting quotes from multiple lenders can save you thousands of dollars. Once you've chosen a lender to work with, discuss when it's best to lock in your rate so you don't have to worry about rates climbing up before the loan closes. Something else to consider is, in addition to comparing interest rates, pay attention to the cost of the fees and whether they'll be due up front or rolled into your new mortgage. Lenders sometimes offer no closing cost loans, but might charge a higher interest rate or add it to the loan balance. So number five is be transparent about your finances. Gather recent pay stubs, federal tax returns, bank statements, anything else that the lender requests. Your lender also will look at your credit and net worth. So disclose your assets and liabilities up front. To consider is having your documentation ready before starting the refinance process. That way it can just make the transaction a little bit more smooth. Prepare for the appraisal. Some lenders may require an appraisal to determine the home's current market value for a refinance. what to consider is you may pay a few $100s for the appraisal, but also let the lender know of any improvements or repairs that you've made since buying your home, so that maybe you can get it in a little bit higher value. So there's some benefits to refinancing your mortgage. Number one is freeing up money each month. Rate and term refinance replaces your mortgage with a new loan that has a lower interest rate, meaning you must pay less to your lender each month. There's a significant opportunity to reduce your monthly cash requirements depending on the size of your mortgage. It could be anywhere from $75 up to $200, maybe sometimes $200, $300 a month. With the refinance, you can also pay off your home much more quickly. You can do a lower interest rate and a shorter term. You can save in interest, and this could be substantial. For example, if you're able to refinance into a 15-year mortgage from a 30-year mortgage, you're putting more cash into your pocket by paying off your mortgage early, saving you tons and tons of interest. So, and you can put that money away for retirement, college, or an emergency fund. Getting rid of the mortgage insurance, PMI, if your original down payment was less than 20%, you've likely been paying your private mortgage insurance or PMI an extra fee on every payment. And if you've got value has risen on your home and you've got that 20% equity, you might be able to refinance into a loan without mortgage insurance. Talking back about your home's equity again, if you have 20% equity in your home, sometimes you can turn to a cash out refinancing, and that's when you refinance your home into another loan for a larger amount to meet specific financial needs and receive in difference the cash. So this might make sense if you're considering using the money to invest back into your home through a major remodeling project or to pay off high interest debt. Number 5 is let's lock in a fixed rate mortgage for you. If you're in an adjustable rate mortgage that's about to reset and you believe interest rates are going to rise, you can refinance into a fixed rate loan. Your new rate might be higher than you're paying now, but you're guaranteed that it won't rise in the future. So lots of good information. Once again, my name is Billy Bryson, Bryson Team Real Estate and Home Loans. And if you or anyone you know is considering making a move or refinancing, please give me a call, pass on my number, or you can visit my website for free, helpful real estate and loan information. Thanks again so much for watching. I hope you found this information helpful. Please make sure to subscribe, like this video, and leave a comment below. Have a great day. Thank you. Bye-bye.